Hi guys, welcome to the weekly overview. It's TinTinTrading and we are boom traders. We're gonna go over week 37 and we're gonna look at the action from last week and give you just our summary and our view of what and how things are happening. I don't think I need to tell you, or I'm sure you can guess, that we're pretty bearish right now from what we've seen over last week. But here's our session overview. We're going to start off with our general models that we show you every week. We're going to move on to the specific price action, internals, sentiment, seasonality, macro picture, and then we're going to finish off with a summary. I hope this is going to be less than 10 minutes for you to quickly sink in with your view and feeling of the market. So the models, this is the new way we're presenting the models, top down. We're going to start off with the market environment. This is really looking at the moving averages, the general moving averages, and the general indexes and assessing how they're working out. We're going to separate that into short-term, mid-term, and long-term view. From then on, we're going to look at the trading environment. This incorporates other things, the breadth. We're looking at a bunch of other things. And from then on, we're going to move on to the risk side of the models, which is pretty much how our trade or how the stocks that we're trading are working out. In particularly, we're using breakout swing trading methodologies that is very much aligned with William O'Neill, the IBD gang, and Mark Minervini. Pretty much we're going to give our view on that. And from then on, hopefully all of this is going to come to the most important factor, the thing that everything should hold on to, and that's the positions. How are we doing in our positions? And that should be like feeding into that position decision that we show. So no further ado, market environment 0 out of 4. So that's currently a sell signal, firm sell signal. Short term and mid term, we're getting also 2 and 1. And the long term, we are neutral at the moment. On the trading environment, we are assessing this as a hard pen environment, or at least one where the methodology doesn't perform optimally. Henceforth, it's good to stay on the sidelines and just stick with cash, raise cash, and stay on the sideline. And the risk model, how particularly the trades that we're doing are working, is currently on. So as you see, there's literally no reason to be bullish and be into the market at the moment. So let's look at the price action and just do some analysis, because it is right at this time when we need to really pay attention to the markets, because this is when we can identify which stocks and which sections of the stock market are performing well and which are supported by institutions. It is in these times that we're finding out the true market leaders of the next bull run. And I'm super, super excited about what's about to come, because these type of corrections usually follow on with amazing trading rallies. For me, it's really about prepping up now and finding those leaders and being able to trade them later on. So here is the NASDAQ composite. As you see, there's a bunch of arrows. I've explained in the previous videos, but just as a summary, these are following the methodology of IBD, the market school, which is a pretty awesome course. If you haven't bought it, if you haven't checked it out, I definitely recommend it. I can always share with you what I've learned out of it. And here is the practical use. I'm actually in the development of a custom indicator for TradingView that can print out and give you and guide you as per that methodology. But it's quite a big project and I'm nearly completing it. But in a nutshell, you can call these the bullish arrows and these are the distribution arrows based on about 20 different sell signals and about 10 or 15 buy signals. We did get 2 plus within this trading rally up. We got our power trend, which is a really awesome switch right at the top. But unfortunately, following on, we got a bunch of distribution signals that kind of turned off the power trend here. And since then, we've been getting more and more distribution and the action hasn't been good. Now, the 2 things you have to look at is A, the volume. This is again, one of my custom indicators on TradingView, which you can go and find and I can share with you. But in essence, we're seeing, and the thing that the indicator is highlighting a bunch of purple and red. So purple signifies down as well as red. And we're seeing that there's literally no bullish action right here. Even if you just look at the volume, you don't look at anything on top. But on top of that, we are actually pushing at a very important low. And if you see that black line that I've drawn here, basically this shows the low of the day on Friday. And what we're looking at is if we're gonna violate that rally day low that we got here. So the rally day low is the kind of the beginning of this uptrend that we saw. And it's a very important low. If we hit that off, basically our buy switch, which is again, some terminology out of the IBD master classes that I've been taking over the years, but the buy switch turns off, meaning that you shouldn't have any exposure. And even now, within the last week, I actually got 100% in cash myself already. So that's important low. If we violate it, then the whole methodology needs to kick in and we need to see a new rally day, a new follow through day, and see how it goes from there. But that's a very important low. From then on, moving on to the internals, things are not looking pretty there either. As we're looking at the thrusts, these are the volume versus down volume and the down volume versus up volume. So same data, different way to use. What's significant here and one methodology that is important is to have a look at when are the days when we're getting above 10. So 5 is the kind of intermediary, like be cautious, and 10 are the kind of the signals. So as you saw on the way up here, we did get a bunch of these blue skyscrapers, so to say, which indicated a very bullish action. So I made some good money up here and traded some really nice names, the ones that were breaking out. At the same time, when we're getting these, we saw that there was pretty much nothing here. However, on the way down, we started getting these higher volume down days, which were very cautioning. Now, what we don't want to see is them piling up here like they are. Now, because this is log scale, they might visually look smaller, but the line again is right up here at 10. And we're seeing 1, 2, 3 days at 10, over 10, and 1 day, which is between the warning sign as well. And at the same time, the volume on the opposite side has been really low. So that's a problem. And this is definitely something that you have to take into consideration, knowing that basically the sell-off is quite significant. From then on, if we move on to the NASDAQ composite and we look at the percent of stock above the 200-day moving average and above the 50-day moving average, we will see that these have been firmly going down since kind of this top here. And we're currently only at 13% of the stocks in the NASDAQ composite are above their 50-day moving average, and only 16% are above their 200-day moving average. Now, this can indicate a very oversold condition, and hence why that we've been saying over the last few weeks that bearish rallies are basically they can be very big. So the rally during a bear market can be very aggressive. The rallies are usually the biggest bull rallies happen during bear markets. And that's because you can aggressively oversell from a condition, and that kind of makes this yo-yo action. This is a big problem and why I prefer staying away from the market, because this big yo-yo basically shows volatility. And that means that you can get whipsawed on both sides of the market. So even if you go short here, if there's a big rally up, but just momentarily, you're going to get stopped out. If you go long here, and there's a big drawdown like this, the one that we've been seeing over the past few weeks, you can again get stopped out. So that's why I prefer more calming conditions. From then on, if we look at the treasury, that keeps on pushing up. Currently, it was at 370, but now we closed the week off at 369, which is record levels. This is definitely one of the indicators that it's showing us that we shouldn't fight the Fed, we shouldn't fight the general economy. And it's something that's very problematic for the stock market. In essence, you want to watch at the 10-year treasury yields and look for them to start making this move if we're going to be getting positive on the market. This is the next internals that we're going to look at are 3 indicators from the market's data. So first is the short-term overbought oversold oscillator. Now we are at this minus 350 level, 370 to be exact. And this, as you see, has gone down straight down I put the dotted line to see when are the other times that we'll be hitting this level. When we got this in mid of February, when the market kept on moving up for a bit, but not enough to create a rally. And we got that at the beginning, middle of January, where we continue to push lower. So it is a level that we haven't seen much of throughout the year. We saw it only in Feb and Jan, and we haven't seen great movements afterwards. Actually, the market kept on moving down. From then on, the 10-day moving average of up volume and down volume shows that basically the pink 10-day moving average down volume has been picking up while the volume has been going down. This kind of divergence is not great either, but very bearish. And lastly, we have the 10-day moving average of new highs versus new lows. As you see, a bunch of stocks are making new lows, and to be exact, 514 on Friday against only 34 new stocks making new highs in Friday. So that's very showing that we keep on going down, and we're going down not in one or two stocks, not only in the big names which constitute kind of massive portions of the moving averages, but generally the whole market is going down, and that is something that we ought to be considerate. Now, I'm also looking at the NASDAQ 80 line, and here I wanted to show you something interesting that I spoke about in the previous videos as well. Now, if you see here, basically the way you assess the 80 line is by looking at divergences. So you either want to look at and see positive divergence, negative divergence, or confirming action. Now, on the way up here, when we started getting this move up, we were cautious, and I have that somewhere on my Twitter, that basically the 80 line was not confirming. That means we are pushing and making these like intermediate new highs, yet the 80 line was flattish. If you see, these lines are parallel. They start off from the same point and end on the same point, yet we see there's a much bigger space here than there is here. So that was showing divergence, and something that would suggest that you want to keep your stops very tight. Now, on the contrary, when we start from this line, from the top up here, and we do that the same here, and we can put two parallel lines, we can see that the 80 line is actually holding better than the NASDAQ. Now, the way you can read that is it is still confirming action of pushing to the downside, but generally we're seeing that holding a bit better. So henceforth, we can say that here we have divergence, negative divergence. Here we have positive divergence. In essence, this could be argued that we can be getting some pushback up to these levels here recently. Now, from then on, we're moving on to the sentiment. And here I've put for you the numbers last week for the bulls and bears, and the put call ratio, and the numbers this week. So as you see, we've lost about 8% of the bears of the bulls, but we only gain 1% into the bears. And the put call ratio is crawling up, not to the levels that we want to see. Basically, we want to see it pushing at this kind of panicking level, whereby we can say that we've been getting capitulated, but that's still better. I want to see it at least to 110, 115, 1.2 would be great. So for me, there's still more room to the downside before I can start making the case for bullish action. And I would love to see the bear percentage over 35, preferably 40. That would really show a really negative feel on the street. And I can expect that within the next 1 or 2 weeks, we're going to get a bunch of headlines explaining how bad things are and how bad the economy is, and how we're going to be getting to the worst recession of our lives, and how things are record bad. Don't worry, we get that every kind of recession. I have a tweet pic on my Twitter about how every year there was a crisis, while SPX was making like 40 or 50 year highs. If anyone's interested, DM me and I'll send it to you. From then on, seasonality. Now, we spoke about that. That hasn't changed, as we have been saying that we will be entering the worst period of the stock market within a year. And that proves out to be seasonally correct. That's showing again why it's important to look at the seasonality. It seems to be more often rhyming than arguing that, yeah, we can look at least some better action within the beginning of October. And from then on, we're going to conclude with a few things, the macro picture. Now we're looking at in relation to the inflation numbers. These are some of the main commodities, some of the main things that kind of can push and give us idea how the economy is doing. We're seeing that prices keep on going down. The red line or the red area is the 50-day moving average. So copper is firmly down. Oil has been pushed down and hasn't peaked above it since July. We're also seeing improvements in lumber and energy. Had this rally up in August, but now we're picking up to the downside with increased volume. So these are good news for the bullish case, not good enough. Maybe some of the reasons why we only got a 75 basis points increase by the Fed and not much, but inventories keep on going up as well and used cars are going down. Yet, as I said before, we had this kind of case. This is a slide literally from 2 weeks ago. We had this move down and I haven't changed it because I want to show you that the analysis and what we've been saying proves right. And go back, the video is there. You can go and check it out for yourself. We did get the follow through day. We did push up. I was expecting this move down and that was the star that was showing where we are, expecting some more capitulation action. So this is exactly what we said. And from here, we need to see what's going to happen. So are we going to move up and make this feeble rally and continue going down and take away the follow through day, or we're going to start moving up for good? My general assessment is that, and I said that 2 weeks ago, is that it is something between the two. So it will be some action like this, more of a sideways action. I spoke about precedents last time. So 1963 is getting much more close to what we are seeing now. Again, I'm changing the period. Previously, I said it was 1990, but 1963 is showing now much more closer play to what we've been getting. So to finalize, everything's red. We are getting all models on sale, and we're in a place whereby there's little case to be made for the upside. With that being said, I'm 100% in cash. I believe we have 1 or 2 positions in Boom Discord trader trading server. So that's unlikely. They're likely going to get stopped out if we continue pushing down. But let's stay on the sidelines, be safe, be disciplined, and look out for the leaders because they're going to show up. Thank you and see you in the room.